Hello and welcome to Indianomics. Today we start a special series on the year ahead, Indian economy in 2025. With the recent state election wins, India's central government will be much stronger and capable of longer-term policies. The US also will have a strong government, but maybe more mercantilist. That is, enrich yourself through protections. In which case, how will 2025 pan out for India? We kickstart the series with Santanu Sengupta of Goldman Sachs. Shantanu, thank you very much. First up, your growth forecast for this year is just 6.4, one of the lowest on the street, which means you don't think that the second half will be a pickup. Will it be slower than the first half?
Hi, Latha. No, we are not expecting much of a pickup in the second half. I mean, the usual suspects will be the government expenditure coming back. Capex has been really low in the first half of the year. Some of that will come back. But we think we are in the middle of a cyclical slowdown, mainly due to overall fiscal tightening, which will continue into calendar 25, and the macroprudential tightening that you've seen from the RBI on consumer loans. And therefore, we are baking in a 6.4%. We have been there for a long time. We just shaved just a tad bit by 10 basis points in our outlook, but we have been at 6.5 for a very long time now, almost more than 3 months. For the fiscal year 25.
Is the exact opposite of what the Reserve Bank has given us to understand, even in the latest bulletin. I mean, they have shaved off second quarter by a bit to probably 6.7 or thereabouts, if you look at their graph. But they're still sticking with a 7+ overall growth, which means for them, the second half is better. For you, it looks like the second half is going to be 6.25 or 6.3 thereabouts, right?
That's right. So again, our point is that you will get the rebound from government capex, but consumption relatively remains slow. And it's difficult to imagine private capex pick up significantly over the next 2 quarters or maybe 3 quarters, given the amount of uncertainty that is there in the world today. So once Q1 of calendar year next passes and we have more clarity possibly on tariffs and US policy, I think that is when we can start baking in some kind of a capex recovery on the private side, and therefore we remain at a 6.4% year over year for fiscal year 25.
Okay. Well, now let me come to FY26. I won't take calendar 25, since in India we all think fiscal. Your fiscal FY26 is 6.3. Now, don't you expect that we have several things going for us? Excellent monsoons, and therefore possible consumption pickup. The fact that we could be beneficiaries of high tariffs on China and people migrating out of China, producers, as well strong government ability to take strong calls. Won't all this add up to something better in FY26?
So firstly, 6.3% growth is a very solid growth print in this world of uncertainty in our view. We think India's trend growth is around 6.5, maybe a tad higher. And therefore, this slowdown in our view is just a pullback towards trend. And there are 2 things that are broadly going on in the domestic economy. One, once you have the second half fiscal year 25 capex rebound, you're again going back to the fiscal consolidation path of the central government. We don't think there will be a departure in that. They have been unwavering in terms of that fiscal consolidation target, probably getting towards 4% in a couple of years' time, which means that you can expect a mid-4 kind of a target into fiscal year 26 for the fiscal deficit. That will remain, therefore, the fiscal will remain a drag. Secondly, there is no respite right now from the tightening of the macroprudential norms from the RBI. I mean, it happened a year back. You've seen the slowdown in credit growth. It's difficult to imagine that will turn around very quickly over the next quarter or so. We are baking in some recovery in the second half of the fiscal year 26 in terms of credit. And then if you look at the world, again, very difficult to imagine a net export boost from where you already are. I think our current account deficit is tracking around early 1% of GDP, right? It's anywhere between 1 to 1.2% of GDP. And it's difficult to, again, imagine getting a material net export boost. And therefore, from fiscal year 25 to fiscal year 26, we haven't really been able to see what will be boosting growth higher towards, let's say, a 7% or so. The caveat I'll just point out is that if there is a material improvement in the private capex cycle and it becomes more broad-based rather than being more concentrated, that will remain an upside risk to our growth view.
Okay. Let me first discuss the upside risk, and I will agree with your downside risks as well. But just playing devil's advocate, the Chinese experience was when the demographic dividend hits, it is a huge inflection point. They did double digits. Many years between 1991 and 2007, that's several years of double-digit growth. You think we won't make it to 7 to 8%?
So 7 to 8 is a pretty high trend growth to think about. Our estimates from the supply side has been in the region of 6.5, maybe a push towards 7 if you do the right things on the supply side, especially on infrastructure development and so on. Now, because you're pointing out the demographic inflation point, I'll just say that, in terms of consumption, we are looking at it in 3 layers. The upper end of the consumption pyramid is still doing pretty okay. What we have been calling as
doing very well.
That's still continuing to do very well. If you look at air traffic growth, if you look at the large hotels, they are still doing okay. It's the bottom end of the urban, which is dragging possibly from the retail credit slowdown. And on rural, we are feeling quite confident about a rural recovery after a very long time. After almost 2 or 3 years, we think that production is likely going to be okay. That is why we have a view that food inflation will come down, and that will boost real incomes in the rural segment. And you're already seeing a little bit of transfer payments happening at the state government level, not so much the central government, but the state government level. Multiple states are making transfer payments, especially towards women, which should boost rural incomes a little bit.
Okay, now I take your point. Now let me come to my downside fears. That's largely exactly the point you mentioned, since a whole host of states are into revenue expenditure because of transfer incomes. Do you expect that we could see some significant downside in the rate of growth of government capex? As you point out, private capex is not, gangbusters, it's just good. But government capex, which was gangbusters, may slow considerably because the states won't be able to put matching funds?
So again, on government capex, there are 2 things happening. One, the fiscal consolidation of the central government has meant that the nominal growth rate that you're having on capital expenditure is slowing down now. We think next year is going to be in line with nominal GDP growth rate. The year after, possibly you're going to grow in mid-single digits or somewhere around that if you're really going to 4% of GDP on the fiscal deficit. On the state capex, I would agree with you. If there's a shift that is happening, and we are estimating around 0.5% of GDP already for all states combined until now, shifting towards transfer payments. If you hold the fiscal deficit constant, then this money has to come from somewhere. And undoubtedly, we think that there'll be some reallocation happening from capex and maybe some reallocation happening from other current expenditure. Now, remember, for capex to continue, you still have a lot of savings. And this is a point we have been making for a long time. You have a lot of savings in India, which is all from insurance, pension funds, PF, and so on, which is anchoring the long end of the sovereign yield curve. And it's just about channelizing that money, which is seeking duration, into duration assets like infrastructure. So you need a quasi-sovereign entities to come out and issue to carry on the infrastructure boost in India if the central government is going to take a step back.
Okay. Yeah, I mean, there is the NAB FID, and then there is a lot of boost to the bond market if the index inclusion were to continue. So there is a possibility that surprises on the upside. Let me come to the external part and then get back to growth if time permits. The external front, you are expecting a weaker rupee, right? You're expecting it to go all the way to 86?
That's right, but I want to be careful here. We are calling it enduring external immunity. If you look at the rest of the world, the rest of the Asian currencies are depreciating a lot more in our forecast. Yes. INR is the clear outperformer. But even with that outperformance in the face of a stronger dollar, which is what we are expecting at least in the first half of next calendar year, we think that the rupee moves to 85, half 86 pretty soon over the next 3 to 6 months. But thereafter, it stays around 86 for the rest of the year. Of course, it is completely contingent on the dollar view. But we think that in this world of uncertainty, and I want to emphasize this, in this world of uncertainty, the immunity that India has is because of its services exports. It is less dependent on global shocks. Everybody in the world is today talking about manufacturing and tariff on manufacturing. But since you're doing so much on services exports, that is cushioning your current account balances. We think that is relatively more structural, and therefore INR is the outperformer for us in the Asian pack.
Okay. No, I never regretted appreciating rupee. I think there is a long narrative going on that you should have a strong currency. You shouldn't. It's good if we are going to depreciate. That will make us, ward off imports, especially Chinese imports, which you speak about in your piece. I just want to come back to the growth argument quickly. I'm not asking you to wear Timothy Mo's hat or Sunil Kaul's hat, but more broadly, do you think it's worth betting on the consumption sectors going forward than capex? Because that's where there seems to be a plateauing.
So I think we are calling out consumption, as I said, in 3 layers. We still remain pretty confident of the absolute top layer, which is, again, our consumption team has been calling out on affluent India. And the very bottom from the rural end, where, from the macro side, we are feeling pretty confident in terms of volume growth, given production, given lower inflation, given these transfer payments. It's the lower end of the urban which we think we will keep lagging. 1, because of lack of income growth. 2, because of the retail credit drag. I must point out one risk which our financial teams has been talking about of late, which is the MFI loan stress. Yeah. If that is going to be materially higher, that poses some risk to the rural recovery. But for rural, the production of the summer crop, that is the Kharif, will be super important to watch, because that is what can start boosting incomes, and therefore we remain pretty confident of the rural recovery.
Okay, totally out of time. Give me a 1-sentence answer. What is the upside risk to your estimates?
Our upside will mainly come from the capex boost from the private sector after the dust settles on what US policy is looking like in the first half of the year.
Well, thanks very much, Santanu, for your analysis of 2025. After this break, we are going to speak to Morgan Stanley's India specialist, Upasana Chachra, about how she sees Indian economy in 2025. Welcome back. We are continuing with our Indianomics series on Indian economy in 2025. And joining me today is yet another star economist, Upasana Chachra, Chief India Economist at Morgan Stanley. Upasana, good morning. Thank you very much indeed for joining us. Well, first up, your growth forecast for next year, that is FY26, not calendar 25, but FY26, is 6.5%. Does this bake in the likely tremors we may face if there are tariff hikes in the US? How much of it is baked in? Or do you see downsides if there is an onslaught of tariffs?
Hi, Latha, and thank you for having me. So yes, our forecast for fiscal 26 at 6.5% assumes that there will be some increase in tariffs by the incoming US administration, but those would be still country specific. So our global team, both on the econ and the policy side, the assumptions that we have used in our year-ahead outlook is that there will be an increase in tariffs for China and also bilaterally for some other major countries such as Mexico or the EU. We are not assuming specific tariff hikes for India in these numbers, and also not assuming that there is a case for or an implementation of the universal tariffs as have been discussed in the past. So those are not baked in our base case. If that comes through, yes, there could be more downside to the 6.5% number.
Okay, so this is the base case. Trump can engender some downside surprises if it happens. Fine. Let me also come to the currency. And maybe I'm making an unfair question because this should beat your currency strategist. But I was a little intrigued that your currency forecast numbers don't go above 85. It is 84 for the current year average, 85 for FY26, and then it goes down. Actually, the rupee appreciates to 81 in FY27. Can you explain? Because there is a school like Goldman Sachs tells us that they expect 85.7 also in 2025.
Yes, these views are made by a currency and FX strategy team, and they do include, a fair bit of what they think about how the US dollar would move. So in the near term, there would be US dollar strength, but yes, you probably will not see that too much in the rupee dollar moves or the forecast that we have in our numbers. Primarily with the view that we do think, and as a both on the econ and the strategy team, that there will be a case for the rupee to get defended and the volatility to be lower. So our view is that given that the fundamentals still remain pretty okay for the rupee and the FX reserves, and generally the trend that we've seen in the past of RBI wanting to intervene to reduce volatility, we do think that rupee will be therefore more range bound rather than depreciate at a faster pace. So that is what calls for our view in the near term.
Okay. Well, any FPI will give an arm and a leg if it's only going to be 85. But right now we are already sitting at 84.5. And there is a fear that it can, go to 85.5 also. Now let me come to the growth forecasts. Even for the current year, you are expecting the growth to be 6.7%, which means you're not buying the RBI forecast for the second half. They are sitting at something like 7.3, 7.4 for the second half. You don't think that's happening?
No, so our numbers were earlier 7%, Latha. We reduced them to 6.7 in this round of year ahead outlook. But most of the cuts are concentrated in the September quarter. So, that is the key debate right now. September quarter growth and high frequency data have been showing sort of a broad-based deceleration. So we do think that September would be weak. Our numbers are going to be weaker than the 6.7 for September. We are at about 6.3, probably where consensus is also right now. For second half, we do expect a rebound, but probably not where RBI is looking at. This is what they've published as yet. So our view is that you see growth picking up in second half, but probably settling more in that 6.7, 6.8 range rather than higher than that.
Okay. Let me now come to your inflation forecasts. Your inflation forecasts are pretty benign, but for the current year, you're still expecting 4.9. That's a big jump from Reserve Bank's 4. No, Reserve Bank's 4.5 is going to get revised because obviously they were not prepared for the 6% plus in the month of October. But 4.9 would mean that inflation really is not falling off.
Yes, so I do think that the near-term hump in inflation that, RBI has also highlighted, we were all expecting, but I think one is that the level is higher than what we were expecting by probably 40, 50 basis points odd for both September and October. And then the deceleration as it sets in will therefore just take a little bit longer, given that you've seen us somewhat of an upside surprise. And it's more mathematical than anything that you will then see numbers being higher. So when I look at monthly data points, you're probably looking at November print, which would still be close to say 5.5. It will start moderating from December because of the seasonality and the winter month impact on vegetable prices, etc. But as of now, at least what we think the numbers for December, Jan could still be around the 4.8 to 5-ish levels, or probably around 4.8 rather than meaningfully lower. So I think it's a lot to do with food inflation and food inflation volatility than anything else. I think, headline X vegetables or core will still be well behaved, but headline per se, due to the impact of food in the near term, will also probably remain a little elevated than what we were thinking probably 2 months back.
Okay. So at one point in time, if I remember right, Chetan was saying that he's expecting practically no rate cuts. But now you all are penciling in some rate cuts next year.
Yes, that's right. We did have a view of no rate cuts for pretty much all through this year. We have added rate cuts for next year. So as of now, we expect the first rate cut in April. We do think, by then there will be more evidence of a moderation setting in inflation. December and Feb meetings, probably with the trailing inflation numbers, will be very hard. And that's why we think the first opportunity would rather be April than before that. Just given how inflation numbers are going to be in terms of headline.
Okay, let me come back to the growth question. Again, I'm going back to Goldman Sachs because that was the first of our series on India at 2025. The fear about growth rises on several counts next year. The fiscal deficit is going to be lower. I think even you are forecasting it lower. Plus, capex even this year may not reach the target. Capex will be even less. It's not as if private capex has picked up, gangbusters. And on top of this, you could have a global slowdown, a Chinese dumping. So what makes you confident about next year's growth? What are the positives for next year?
See, I think structurally, the story for India delivering around 6.5% growth is still something which is doable given where probably macro balance sheet and corporate and financial sector balance sheets are. Yes, there will be fiscal consolidation, but it's unlikely to be a lot led by, expenditure compression. Capex numbers we've already seen moderate. If we were to assume that second half picks up, will still be lower than last year. And now probably seeing, yes, but from going forward, probably you'll see capex numbers in terms of growth rate remaining where they are. You would see more shift in revenue expenditure in our view that would lead to the fiscal consolidation alongside pickup in revenues, and therefore the fiscal drag on growth should be lower from the fiscal consolidation bit. You will probably be seeing easing in the next year, and that should help from just the impact of monetary policy on growth, and therefore growth settling to around 6.5. I wouldn't say that growth is on an accelerating and upside trend, but more like a settling on the 6.5% normalized trend, which should be doable given where the structural parameters are for the economy.
Okay, it's almost as if it is India's natural rate of growth. Okay, very quickly then, if you can tell me what will be the upside surprise and what can be the downside surprises we should be prepared for.
On the upside, I think the key will be, as you mentioned already, on the private capex side. We are seeing some green shoots, but yes, it's not at an exuberant level. So probably external demand can come back as a bigger supporter to this overall end demand, and that can help improve the private capex cycle, which then I think leads India to a higher growth path or a growth trajectory on a more sustainable basis. On the downside, again, most of the risks would emanate from the external factors. I think at the moment, what type of trade, tariffs, immigration policies we see from the incoming US administration will be important. Again, that may still impact more of the second half of the next year in our view, because by the time it's implemented and it flows through, in terms of real economy variables, there will be some lag. But of course, markets and sentiments will start reacting much before that. But from a real economy perspective, probably second half would have more risks associated with what policies we see in the first quarter next year from US.
Oh yes, that is the unknown, isn't it? Okay, so 6.5, the natural rate of growth for India, not 7. Thank you very much, Upasana, but that is still better than the Goldman Sachs forecast of 6.3. With that, we wind up on Indianomics. Thanks so much for watching.